we are talking about weather today. We will dive much deeper into the topic and especially connecting it to energy trading and energy portfolio hedging. And as always, I have two experts with me who know much more about the topic than I do. So they will set the scene, give us an introduction to the topic. And then there is a part where I will present the upcoming solution from NMAG for weather trading. And we make sure that with our presentations, we set the scene for good discussion, inviting all of you to participate in the Q&A. So please feel free to drop in some questions on the chat or use the Q&A function. I will pick these up and ensure that we have a lively dialogue afterwards and discussion. If there's some very specific topics, we may take them away, but we try to get you all the responses to your questions have. All right, let's get started. Introducing quickly our guests. We have on the one side, you see Ronnie Bentley-Spür. He's the senior lead originator, from Munich Re when it comes to weather derivatives. Munich Re, major player in the market, taking significant risk on the weather side, and he will share his experience with the market, talk a little bit about the maturity of the market, how it's used, what kind of trends he sees in the market. And then we pass on to Akin Sain, who's from TrailSportStone, as well, lead structured for PPAs, where he has this day-to-day experience of managing risks for renewables and providing market access to hedge them. So from Akin, we will get more of the market, the user perspective on how energy traders today interact with these products, how they use them for hedging their portfolios. All right, enough of an introduction. I would directly hand over to Ronnie. Thank you.
Yeah. So Jens, thank you for the introduction, and all the participants, welcome to today's session. My pleasure to talk a little bit more about weather derivatives and our view as Munich Re as the risk taker side, and kind of what type of products and especially also parallels we see. I mean, our shop basically started good 10 years ago as a weather and commodity trading shop, mainly starting off with the need of the larger utilities and all the players in the retail business to hedge temperature exposure. I mean, the reason behind it is quite clear. If it is too warm, nobody's really heating, so you don't get the revenue from the heat. You would sell out on one side. On the other side, if that is the case, you also have to rebalance your gas, meaning that you most of the times have to sell it off cheaper than you actually bought it. Or you have the supply side risk that people hedged a lot, and especially in the cold winters, on those winters, like also now, that is just behind us, where gas prices being immensely high due to multiple reasons. Everybody was scared from a very cold scenario where you have to pay way more for your gas than you actually been expecting in your plan, right? So all the structures that we are doing are, in first place, are weather-based. So that could be everything from temperature, as mentioned, could be wind speed, solar radiation, stream flow, precipitation. And that all is a standalone or in combination with a commodity price. So most of the time it's either temperature and gas or temperature and power. Now we see a lot of structures around wind speed and power or solar radiation power, which totally makes sense to have those kind of structures in your book. And I think when you go for the question, like, what are we currently seeing? So in our portfolio, still 40-50% are temperature-based risks. And those are mostly hedged somewhat across a winter. So trades Q4, Q1, right? So half a year around the winter season are quite typical. Other players, they're more looking on the seasonal or on a yearly basis. So you have like full calendar years of structures. Those are very typical. We sometimes also see multiple year deals, or where you just have the Q1s of multiple years as such. But if you now see the transition, now probably 2017 starts slowly to build up, seeing more renewables coming into the weather hedging for good reason. So I believe, especially around wind, that totally makes sense. And that probably makes 25-30% of our portfolio now. So it's wind volume transactions, mostly somewhat related to fixed commitments. So somebody, especially in PPAs, right? And I think Akin will talk a little bit more about that. Somebody has the volume risk. no matter if you're a corporate off-taker and you have pay-as-produced PPAs coming in, you have the volume risk of how much wind is actually out there, or you're the wind farm and you have a baseload commitment to somebody, you have it, right? The same also for larger aggregators that have those utility PPAs out there. So there's a lot of wind volume that you can manage. For us, it's mainly shorter lived structures on one side. So it's everything from multiple or single month to multiple years. I think the longest structure that we currently have in the book is about nearly 10 years. So that's more than the longer term outlook, more the project financing side or PPA matching tenor, but more frequently it's actually shorter lived structures around a winter or a year. And then probably to round that up, well, other things are outside of the energy segment as well, transportation, low river level at the Rhine, or offshore construction risks that are picking a little bit more up. But yeah, in our portfolio set, wind, then also nowadays, cannibalization plays a large role, where we've been also quite leading the market and bringing up products that can hedge that. But then again, right, it's more the shorter lived, the quarter or the year, because then if you go out 2-3 years, it's a very fundamental risk that you get in the books, how much new capacity is brought to the grid, political measures, etc., etc. That's not really what we want to warehouse. We warehouse weather, and when we talk about weather, we mean um, structures that are active along the mean, right? Munich Re as a global reinsurer has very extreme exposures to earthquakes, hurricanes, tsunamis, pandemics, right? So this is like the 1 in 50, 1 in 100-year event. We are more, the 1 in 2, the 1 in 5, the 1 in 10-year event. And this means we are actually diversifying the Munich Re book. This is what we bring to the table. Just the difference is being on an umbrella of a reinsurance company, we don't do too many reinsurance or insurance structures. It's mainly actually ISTA paper. So they are very bespoke, over-the-counter transactions that mostly have a very lengthy discussion process, right? You have to make people feel comfortable with the product. You have to do the onboarding. You have to make the structuring. So processes can be somewhere between multiple months up to multiple years until you actually do the first trade based on weather. But we see more is that people understood that nowadays risk management and that all across the board, right, especially with all the pressure of levelized cost of energy, especially in the renewable energy world, means you have to figure out what risks do I have, put a price tag on them, and figure out who's the best market carrier out there or internally to cope with that, right? And I think there, renewables understood that you can't hedge necessarily, or you can basically say make wind or make sun, but you can hedge those risks that are inherited in those sources just by financial measures. And this is basically what we're bringing to the table here.
Yeah. As you said, you do very bespoke contracts. I mean, you can be very specific, in installation, local risks as well. What are the limitations to this approach, and what is maybe as well the beauty of going this route?
Yeah, so we can go as detailed as possible on a single wind farm. So you would think about taking even data from the SCADA system, right? Really like from the asset itself, and bring it all the way down to net production, linking that to a power price. But that makes it more complex, right? And also brings more risk into the equation. Whereas if you have index-based solutions on the other side, based on a wind production index or just a reanalysis data set like ERA5 or ERA2 or whatever you have, you have more basis risk. But on the end, I think it's always the finding the right balance between the basis risk that you still hold on the one side and how much risk transfer you're getting in the sense of how much money you're paying for it, right? You can find 100% hedge, but that's incredibly expensive. So the amount for the premium might be actually what you get in risk transfer in the end. So that's one. And then it's also the aspect of not every counterparty basically has that computing power, has that legal support, has all that knowledge around quantifying it, because it is a process that takes time and resources. So the beauty of it, it is maybe a little bit smaller in basis risk, but it is a lot of effort. Whereas if you go to, let's say, very standardized solutions on a platform like we're discussing today, that opens up so much more room, and it's also faster, right? If I'm a risk manager and I have a good plan for next year, might have more time in hedging my portfolio than if I'm a trading shop and I lock in a certain position now on power, on gas, and I need fast to turn around to find a hedge actually to offset the position or to support my position, right? So there, a platform solution is just like, boom, you go out and you see a price rather fast instead of sending me a request, having structuring, routing that in somewhere in our pipeline of deals, and then getting back to you a couple of days later with a quote, right? So both have the cons and pros, right? But it is just also an entry point, I guess, for players that using platform solutions already with power and with gas and don't have that power, that manpower actually to look after weather derivatives, or sometimes even don't have experience with weather derivatives in an ISTA paper, or they're more used to Deutsche Rahmenvertrag solutions or whatever you have, right? There are multiple reasons, I guess, to look also into index-based solutions on platforms.
Yeah. Now we got the feeling as well when talking to market participants that the hedge itself is not so complex. Yeah? If you understand your own data, but everything which comes with it, going through contracts, the pricing discussions, etc., that makes time, maybe time, and as well consume a lot of effort. And that's the opportunity we do see to standardize things, make it much more simple. And approachable for many who are still maybe standing outside this market and watching with interest whether derivative trading can bring to them, but are not yet active. Wonderful. Someone who's really active is Akin. Yeah, so he's it's his daily job managing the risks and hedging the risks of PPAs. So I directly hand over. Thank you, Ronnie. We hear more from you later. I guess there are quite some questions, but let's get the market participant perspective.
Thanks, Jens. Hello, everyone. And thank you for the introduction, Ronnie and Jens. So just briefly to mention about what we are doing at Trailstone. We are providing risk management and market access services to renewable producers and to other market players in Europe. And me and my team, we are responsible for building and managing a portfolio of PPAs, especially in Europe. So why we are so enthusiastic about about the NMAC platform is we are an end user of the weather derivatives, as you described, Jens, and we are looking for basically increased liquidity in managing the volumetric risk. So, and to detail this one a bit, as when managing the PPA portfolio, we inherit the commercial risks of the renewable producers. It's the price risk, the volume risk, the price cannibalization risk, etc. And the price risk is kind of known to anyone in the energy market, and there are very established products for managing, mitigating your price risk. Standard base load, peak load contracts, non-standard contracts, OTCs, exchanges. So it's pretty much everything there. And also when managing our PPA portfolio, we can continuously adjust our position to mitigate our price risk. So, I mean, we know that it's just one click away. But after you hedge your price risk, especially for PPAs or for renewable producers, you are still exposed to the volume risk because you don't know exactly how much your asset will be producing. You might derive some statistics from historical data and so on, but what you will come up with always is the range of production values, basically. And depending on the market conditions, this volumetric risk, the volume risk could be quite significant. And standard power contracts are not as efficient to be able to mitigate this volume risk. And therefore, we rather use the standard volume index deals or transactions to mitigate our risk there. And I mean, the precondition is that you have some degree of correlation in your portfolio with the national wind or solar production, but this is usually not a very exceptional request, so to say. So unlike the power contracts or power markets, the volume products are not as liquid. I mean, there are limited number of counterparts, right? Like Munich Re writing these derivatives, and also the transaction time might take a certain time. Basically, it might take a while, and like the price risk, I mean, based on the market moves, you might also want to readjust your position on the volume because the market price is changing all the time, and right now we are far away from being there basically. So the volume products are not as liquid as the standard power contracts, and we are expecting basically increased liquidity and a bit of comfort in trading transacting the volume products through the NMAC platform.
So you today, as a real trader, you are this kind of more fast-paced market actor who needs prices fast, or how much time pressure you have in your daily job when you hedge these things?
Yeah, I mean, so like again, maybe because it's not as liquid as the power, so we are not obviously adjusting our position as much as we do our power position, but I think provided that we have such a market, we would be an intensive user. Yeah.
Speed this up. Yeah, thanks a lot. I mean, what we heard a lot is really on the one side, very valuable bespoke hedges coming with all the complications Ronnie described. On the other side as well, growing renewable portfolios who are not hedged against these volume risks right now. So there we have perceived really a gap to close. And it's not an easy one. So there were many attempts to say that as well in the past, introducing wind futures from EX or NASDAQ, which we're not seeing the resonance from the market, or were not, let's say, picked up and creating really a liquid market. Still, we want to give it another chance because we feel it's the right time right now. Yeah? So time is always important when you introduce something like that. And I think the wider discussion, we see that traditional wholesale products on the power side, peak power or base, are simply not fit for purpose anymore when it comes to renewables. And you have more than 50% renewables in the system. So that's a challenge to us, a challenge we accept or want to accept with bringing out some more innovative products as well. And I would use now the time quickly to run you through the planned offering, which we are bringing to the market beginning of next year. And that should complete basically a little bit the stage for discussion, picking up questions from our participants. We received already a few. There's hopefully more to come. And then we get all of our different perspectives together and try to get a good discussion going. I jump on sharing my screen. So mentioned before, we will offer products which are connected to weather risk, to offer very simple hedging opportunities on NMAC platform. I will a little bit repeat what we just heard from Akin. The market value is at the end volume and price. Prices are regularly hedged on wholesale markets. I think there is a multitude of products for the forward markets, future markets to spot. When it comes to volume, there is nothing standardized today, and that's the gap we want to close for wind, solar, and temperature. Using one example now on the next slides a little bit, I focus a little bit on the wind topic. So we work with a classic example of a wind farm, where you see on the right side an expected curve of utilization. So that's the production you can expect from this wind farm based on historic data or some prognosis. And then you have the realized curve around it, which is especially in the wind-heavy months of the beginning of the year, iterating a lot around this kind of expectation. So there's a huge gap between what you expected and what you can at the end deliver. Meaning you can have a risk, especially if you're having lower production, significant income risk, if you're the owner of that wind farm and have not sold basically that risk with a PPA to someone on the other side. Yeah? So if you carry the risk of production volume, you have a significant potential for losses, and that's what you want to hedge with standardized products. Jumping on the next slide, how does the solution simplified look like? We want to offer very standardized products against weather risk. Again, repeating wind, temperature, solar, and they will have a national coverage, to say that from up front. So we are again not talking about a very location-specific product. We talk about a national contract, which is a sufficiently good hedge, approximating the risks you have in a specific location, but it's never a perfect hedge as well. But it allows for standardization. It allows to bring more supply and demand together in trading one contract. The settlement will happen against the NVAX indices. I come to that on the next pages. We work here together closely with Energy Weather, who developed these indices and tested them and uses them already in the market successfully. Trading against the index is exactly this kind of standardization. So you're not trading against some real measured data for your specific wind farm or parks. You trade against the index. The product is a financial swap, if you wish, by definition. The payout structure being resembling very much a contract for difference. I will come to a chart of that which explains that in more difference, but saying as well, it's not an option product or so where you hedge for extreme events. It's kind of a linear payout curve, which allows you to hedge and makes it much more accessible and easier to price. We will bring this on our RFQ trading platform. I hope many of our participants are already users of it, so I will show that as well in more detail. But it's a very established process, especially creating liquidity in markets where liquidity is scarce, where it's difficult to find prices, negotiate prices. This is when the platform works really, really well. So that's why we do see a very good fit to weather derivatives and differentiate ourselves as well from exchanges who operate an order book. Which works if you have high liquidity in the market, always prices on, but in low liquid markets, order books have their limits, and that's what we want to deal with here. Going onwards, one slide on the indices. There are three of them: one for wind, one for solar radiation, and one for temperature. It's very transparent calculation based on the ECMWF data, so European publicly available data. We use here the day-ahead forecast data, so not the measured data, but the forecasts for the next day. So they're highly available and super easy to reconcile with data. We can provide a freely 30-year history to everyone who wants to compare that with own production curves and do some own calculations. So it's highly accessible and there's no magic in this, no hidden calculations. It's highly transparent and it does deliver a sufficiently high correlation. Again, not a perfect one, but one which is a rather good hedge for an individual wind park or for a portfolio. And you have these kind of cascading products if you aggregate them easily. So you can trade contracts, if you wish, for weeks, for months, or for years, quarters possibly as well. That's very easy to cascade. A little bit right on the giving you already hint how this looks like. So if you think utilization as a wind park, 1% of utilization translates directly to €1 of price of this kind of product. I will show that in more detail. So again, we try to keep things super easy here and transparent to everyone involved. Going on, if we say this is a national contract, that means we have to aggregate data. We use here the different countries and regions of Germany with their installations. So depending on the installations, we have a different weight in the index. You see this here, the Nordic countries here, Schleswig-Holstein contributing 12.7% to the index, while Turing below just 3.1. That gives us kind of a balanced view on the whole installed base in Germany and should allow for a very good proxy hedge. I said it several times, it's rather good or sufficiently good as an index. Here, two examples. You see here on the right side, two comparisons. The upper part shows NVAX 22 in comparison to Magdeburg 22, so the real measured utilization in the market. And you see that it's very much swinging in parallel in the seasons. Below, very similar pattern as well for Essen. So we're very close to that. Very good comparison. What you do see as well is kind of these effects of different locations on how they compare with NVAX. So yeah, Magdeburg being more in the east, Essen more in the west. Wind comes usually in fall as well from the western part. So you have different patterns, how overall the national, let's say, wind intensity is developing versus these specific locations. But especially in the very interesting, because volatile months, January to March, there's a very good representation by the NVAX index. And now I don't go into the details. Believe me, it's sufficiently simple that I understand it as well. And I think we could provide all the calculations and the data around it. I want to simplify very few slides here. So yes, for sure, you need to calculate your exposure to wind. You do this usually that you have an expected earnings calculation, which you see here at number 1. So delivering this wind park some 5 million euros, and then you calculate a low wind scenario where you have the utilization, which is only 20%, so deviating from the 30, and you have a high wind scenario, 40% utilization versus 30, compared with, or brought together with different kind of expected power prices in these scenarios, you get this exposure in the low wind scenario, that you have these kind of potential losses of 1.1 million. And on the other side, in a high wind scenario, you have these kind of gains of 600,000. And that is the basis for the calculation, how you can hedge that. If you want to get rid of these kind of low wind earnings, this risk potential, you jump on and you take that exposure and calculate how many lots, so how much of the standard product you need to buy or sell. In this case, you go long and sell 151 lots to hedge the risk you have from this specific wind park. There is transparent tools behind that, or Excel sheets we can provide how to calculate that. It's again very transparent and not super complex. It's just a little bit, it requires a little bit of different thinking. If we always think about megawatt hours or euros, here we have to work with lots to represent the hedge. Coming to the payout structure, I mentioned that before. Very, very simplified, schematic way. If you look on the x-axis, you have the utilization of the wind park, and then you trade at a certain price. This is where the blue curve crosses basically the x-axis. That's the fixed price of your contract. Then you settle against the NVAX index, which is here explained by the blue line, and you come to a payout on the y-axis, which is compensating for potential losses if the utilization in this case is lower than the traded utilization, the fixed price. So very simple kind of monetary payout structure of these products. All right, that was a little bit theoretical. I closed that part quickly, giving you a very quick look on the platform, how that looks like. All right, so let me recapitulate a little bit. So we defined here the product in this request creator, very simple, I repeat. For request, we're looking for a wind product here. We are on the sell side for a contract period of February 24, and I entered these 151 lots here, which we calculated, which are adequate to hedge the risk of this wind park. It shows you as well here the exposure per percent and per day in euros, which is automatically calculated. So you have this kind of confirmation as a back loop. Then I jump in and I prepare to send out the RFQ, which means when should it happen? I go for now because we don't have any time. And I give a certain duration for counterparties to respond with prices. Let's say we take 10 minutes or 30 minutes here, can specify that as well as longer periods. And I have to specify with whom I want to trade or want to invite to this RFQ. Here we prepared a list for weather derivatives traders, which can be customized for different products and situations. So we choose just one list here to keep it very simple. And then I send it out. So on the right side, you have seen already this one here in the middle, that this card has been filled up. So it shows again here on the top, the RFQ is running for close to 30 minutes. I am Tony Stark, by the way, so I sell here. And then I see already here first prices coming back from the counterparties I invited. I see again here all the counterparties who are online. Yeah, I see he was working on it. So here you see the double. Here's this person means there's a certain trader on it. He hasn't signed it to himself and is quoting now. We can invite as well external counterparties who are not yet NMAC customers. So we are open to everyone to participate here, and the prices are coming back. Yeah. As I want to sell here, I can compare prices and can choose the 30 euros. I can go back as well and say, hey, I want to be bold here. Why don't I go with a 30.10 and make that a counter proposal to everyone in the market? Send it back here. Yeah. Last confirmation price proposal is out in the market. Let's see if someone picks it up. Yeah, done. Another counterparty accepted that price. Trade is done and moves already in the deal history and is captured in the system, and the trade is done. So that was the very simple demo showing you we have it on the platform. It's running on demo. We try that already with some beta users right now to refine the product. But overall, it works really, really simple, very similar to all the other commodities we have on the platform. So who's familiar with the use of the NMAC platform will find it super easy to buy and sell as well, whether derivatives being in wind, solar, or temperature. Yeah, that was a short demo. I just wanted to share, hope it gave a little bit of flavor what standardization means and how easy it can be. With the intention, as we said, to bridge or close the gap of non-existing, more standardized contracts, which are more accessible, easier to price, and as well easier to use as a power hedger, where you want to be faster and maybe sometimes get as well rid of certain positions on your weather portfolio if circumstances change. In this bespoke world, that's quite hard. Yeah, you always have to renegotiate with another counterparty. If you have a standard product, you just put it back to the market. All right, that was the first introduction. We got a lot of questions. I would jump now on them and pick them up, but please continue so that we get a good discussion going. The first one I take here: what countries do you cover with weather hedging? Speaking for us, we start in Germany, as always, with the ambition to go in other European countries as well as soon as we have overall, let's say, traction and see liquidity and interest, then we're happy to move as well. Let's say, yeah, Italy, France, Spain, other countries where we are active. I assume, Ronnie, you're active in all of the markets? No? Is there?
Yeah,
yeah.
That's quite correct. I mean, we do have two teams. One is sitting in the woodlands a little bit north of Houston. They're trading North and South America, and we basically can say that we're doing the rest of the globe, whereas core markets are everything in Europe. So Germany, France, UK, the Nordics, all the Southern Terrain, Eastern Europe, everything. But we're also looking into, of course, our markets. We're strong in Japan, Australia. Start looking now, of course, where wind is or where volume comes up. So Taiwan is something, India, Korea, all those markets. So yeah, there are just a few where we couldn't trade.
Yeah. All right. I mean, just saying we start in Germany because we have a very high interest here from small and larger players to interact, but it's really the intention, sure, to go as well to Scandinavia if this picks up and we have proven that it works. So that's the clear direction. Then we get questions around who's taking the risks in the market, maybe explaining that a little bit as well. So we clearly, starting again with NMAC, we are not taking a risk. We are just the platform bringing together counterparties. That's our job. And there's a specific question around speculators as well, saying that speculators may develop in a market, I would say, if it gets more standardized, I guess. But today, it takes companies like Munich Re or market participants to actually carry the risk, no?
Yeah, I mean, they're risk takers like we are. Other people that are active in those fields are, of course, other trading shops that have offsetting positions. Or, of course, what we see more and more is also hedge funds moving into that segment that have certain commodity positions and trying to find negatively correlated positions to offset those. That is, I would say, a growing field again, right? Where people are active in the segment. But yeah, from a pure risk-taking perspective, and that's probably important to mention, like when we take the risk, we keep it, right? So we are a risk warehouser. It just happens in rare cases when our portfolio in a certain parallel, like wind or temperature, is full to our external limits or internal set hurdle rates. We say, okay, we go out to the reinsurance market and hedge our whole portfolio or parts of our portfolio somewhere with another reinsurer. But normally we take the risk, we sit on it until the deal runs out, right? That's a little bit how we normally operate. But yeah, of course, there are other players that take weather risks for various reasons.
Yeah. Hakim, who are your normal counterparties if you interact in a market? Not asking for names, but a little bit categories of
Sure. I mean, basically, right now there is limited number of counterparts, and it's mainly the reinsurance companies and funds. Yeah.
Mm-hmm. Yeah. So there's a question as well, which is attached to that. Who are participants and what are regulatory considerations around this? So saying it's a financially settled product, clearly. It compensates by a payout against the index. So usually, very often, it's based on an ISDA contract between the market participants, as it's normal. I can say we are working on a platform contract so that people can just directly sign a contract with the platform as all other market participants to speed that up, the market growth, and make it easier. I think from a regulatory risk perspective, it doesn't come in with any specific, let's say, requirements, as we are not talking here about option contracts or similar. So we have this kind of very linear payout structures, which should make it rather easy to deal with these products as well. No, Akin, is this a valid description, or do you see there any challenges?
No, I would see it the same way. And regarding the market participants, maybe just one thing to add. I think, especially now, the wind volume is become one of the key volatility factors in the energy market, like having a big impact on the prices. So to be honest, like for any market player in the energy industry, this could become one way or another like a tool to hedge himself. It could be gas-fired power plants, like it could be producers. So there are a lot of parties basically, impacted by this volatility, and whoever wants to hedge, it's a good product.
Yeah, I think they're also like tapping on that. I mean, I hope nobody that's on the call has been now actively involved in those situations. But I mean, on the other hand, I spoke to a lot of corporate off-takers who said, "Whoa, great! We're done with our sourcing activities. We have like 10 years baseload PPA is secured, so we're cool, right?" You saw in the news a lot of examples from Sweden. Not good wind scenarios, prices been high. Wind farm just got liquidated, right? It just went bankrupt because it had a baseload commitment, right? It's probably not necessary to match it, like right when you enter into the PPA and going for an option on an hourly basis, because then you have 860 options a year, which is incredibly expensive. But looking at the monthly level or looking at the yearly level and really trying to put and lock in some volume and then roll it forward, right? I guess that totally makes sense, and everybody understands it now, that even if you have a PPA somewhere involved, you're not safe, right? Like somebody, as said before, somebody has the volume risk, and I think those are great tools, and as Akin rightfully said, that will pick up more and more, right? Because it becomes obvious that if you have it in your portfolio, and especially their wind, it hurts a lot, right? That's one. And then second of all, as said before, Akin, quality factor or cannibalization. So what are you capturing? If you look into Italy, if you look into Spain, you see the scenarios, power prices are going somewhere to the direction of zero, especially in the nights, right, when no demand is there. So those are all things that we now have to, as a market, to find solutions for it, right? And I think that solutions with index based on a country, right, those are a good step. It's one building part of it, right? I wouldn't say that's the solution for everything, right? But it is one good building block for it, and probably answering, I guess, also the question, is there something for Scandinavia? There are already production indices that are existing for Scandinavia that are traded, let's say we trade. I guess also Jens, as I understood you, that's also the plan, rolling those out over time, right? Adding more markets to it, and then seeing how it scales.
Makes sense. If you, Akin, from a trader's perspective, need to draw a line between more specific bespoke products versus standard, how would you balance the pros and cons for both in each?
I think, as also, I mean, Ronnie mentioned before, it's a bit a matter of the price, basically. I mean, if you want it very specific and you have to pay for it, this might already be more than the basis risk you have. So, so therefore, I mean, I think we are also fond of maybe having both options is kind of good to have, but for the basis, especially this, like the fast pace trading this or transacting these products with some general indices, I think this is very useful for the market players.
Picking up here more questions. There are a few questions around our offering, which I would like to summarize. So the idea is that we go live with this before eWorld, hopefully in January. So technically it's already live and getting tested. What we want to have is the strong support from the industry. So we have aligned with more than 40 companies who in principle support us and want to go active on the platform. We're working on getting them partially as new customers on the platform. There was as well a question, can we name a few? Yes, we will name a few. There are a few we are extremely happy to get connected to this project, and we will do so in the upcoming launch. Don't go now through the list here in the call, but this will happen. So there is strong commitment, which we're extremely happy about, because we know how hard it is to get a market like this rolling. But with the support of the participants, I think we have a very fair chance altogether to really change how this market interacts and operates. And there's a very strong joint motivation to get this going. So again, as you see here as well, great participants in the call. That's what we are really what we need here in order to penetrate the market. In this sense, most of them are active in the German market as well. Again, there is more to come, but we need to prove to everyone, I think, that this trading works in Germany before we stretch out to other regions. So please be patient before we go to France or Scandinavia. Focus will be, at least for the first phase, on Germany to get it going. On the EFED contract side as well, a little bit. I mean, there was a question of EFED and ISDA. We don't want to go here now in a seminar around the legal requirements, but maybe as well from you all. Usually we have ISDA contracts in the market. How difficult is that to connect with new market participants to negotiate these? Is this something which needs long-term preparation, or is this kind of common practice already?
Probably start from our side. It is normally quite a smooth process, depending a little bit how much experience our counterparties already have. I mean, it goes through KYC. You have to get some, credit approvals and a little bit legal approval, but normally, I mean, we just onboarded a Finnish counterparty within 3 days, so that's quite smooth. It really depends also how much people are hammering on an ISDA master agreement, right? But it's not all the case that we do master agreements. Sometimes just the ISDA long form, etc. So the case by case basis, but it can be everything from a couple of days to sometimes also a couple of months, but it's really it's quite specific. I would say the majority are more smoother going these days than very complicated. Really depends on the houses you bring together, right?
Yeah. So there was a question when to get ready. If you want to join the market early on, I think it's time now to get ready. Take yourself a few weeks to understand the products, get some contracts in place, and then up you go. But a little bit of preparation is needed, and we hope that many are ready from day one to contribute to liquidity. Maybe a good question to Akin. We just got this here as well from the audience. Would this be similar to a power derivative market, which is a zero-sum game? How do you see that as a power trader? What do you envision there, how this develops?
That's a good question, to be honest. So, I mean, wishful thinking, I hope we go in that direction. Basically, like we have a lot of counterparts trading for their basically for their portfolios, for hedging their risks, and yeah, and we increase the liquidity. So going in that direction would be definitely wish from our side.
I think one big difference we see is that in the power market, you have always rather transparent prices to everyone in the market. So prices are well understood as a signal as well. In this market, I think we have some historic utilization data, which gives you a certain expectation as well for the future. But where we want to contribute is seeing really that we deliver some traded prices as well to market participants. So these price signals can be picked up and can be understood for the own portfolio and trigger some action. I think this kind of feedback loop is not existing today. There is no price feedback loop happening in any of these these weather products today. It's kind of very intransparent, bilaterally traded today. And I think not in the first phase, but in the going forward, we can definitely bring more transparency to pricing there.
Yeah, I would fully agree there. I mean, like for us, we're finding prices right by quoting, by seeing where if our counterparties, give feedback to see where the market is, or just by winning or losing deals, right? This is basically how we currently finding sometimes the markets, right? So that would give some additional transparency and clarity around certain things, right? Or we look what's traded on a CME and temperature, etc. So it's just limited measures that you actually can find prices, right? That would give an additional one to it.
Yeah. But if I understand right, a little bit provocatively, you're happy to contribute to more liquidity and more visibility of prices, more transparency in the market in order to get it going, in order to attract more participants and a little bit, get into a scalability of this market that takes some, I would say as well, some action from all current players to help that overcome.
No, certainly. I mean, we have also just a limited sales capacity, right? Like in the amount of originators in a lot of markets, and also the size of players that we actually can target and work on also on the other side. So that would give, of course, an additional layer of, let's say, a channel to bring more market players into weather derivatives. So,
Yes. There's a question regarding standardized as well as Quanto swaps, so which include not just the volume side of the hedge, but as well the price, combining them both. Maybe passing as well the question to both of you, is this as well a way to standardize it, or how do these products, because they do exist in some other markets, compare with a pure volume hedge? What's the biggest?
Maybe. Sure. Maybe I can talk briefly about this one. I mean, it's definitely basically the Quanto index is the one, let's say the ultimate hedge, let's say for a PPA portfolio. So that's the most effective one. But from my experience, or basically it's the reason, the fact that it's so effective, maybe it's the reason why it's not so liquid. So it's I would say the volume index products is much easier to find and trade compared to the Quanto index. But we would be definitely willing to see that also some liquidity on this one, maybe on the NMAC platform.
Yeah. And I mean, my view to Quantos is, or our view is, I mean, we trade them, as said before, right? So temperature and gas, temperature and power, and wind and power, and all those things. So that's possible. And we have a lot of counterparties that being in the time when it was still existing, comparing their physical, flexible gas hedge with a financial equivalent in form of a gas temperature quantum, right? Of course, that became more when nobody could get really flexible gas contracts. The requests became more on one end. On the other side, we as a reinsurance house have also just limited capabilities actually to do those transactions, because we are basically taking the volume risk on the weather, and we take the correlation risk between the weather and the commodity. That's basically going on our book. But the commodity risk, it's such the pure commodity risk, we are basically hedging out through the back door. So that means we are in the need of other market participants that can give us, straddles on gas price or Asian options on power, etc., just basically to hedge our commodity position out, right? So if we look at 2022, then we probably closed just less than a handful of temperature gas options because none of the hubs was really liquid. Nobody really, no bank, no other utility, no trading shop was actually able to give us those, right? So they're always quite limited. But on the other hand, our view is, yes, we can do those and we price them and so, but it's probably, you know, there are other instruments to think about it. Like if you basically protect yourself with another just pure commodity position, so futures position on one hand, and then go and find the volume position somewhere else, that's probably the cheaper option you should go for, and instead of going, you know, for the all-in, right? I understand that, and it works, and we do, you know, 2 quadrant quantros, we do 4 quadrant quantros, and you know, surprisingly, sometimes even if it's really cold, gas prices low, and vice versa. So you get sometimes a little bit of present of getting a payment in a swap that you didn't expect, right? Because the market goes crazy like we had last year. But generally speaking, quite normal. If things are normal, stuff is quite correlated, so it becomes a little bit more the expensive option.
Yes.
But of course, the basis risk is lower. So
Yeah.
then again, it's the trade-off that I've been discussing before, right?
Yeah, it's a little bit what we saw as well. So trade-off between, let's say, perfection you may get in these products, but they are very complex, more difficult to price as well. Not so approachable, I would say, by many market participants who are actually unhedged regarding weather risks. So we thought as well, it's kind of a natural step to start with volume products. And then we see, but I think it's a major step forward if we can bring this to a liquid market. And then there's so many more options how this can develop, but it's the first step which matters. And Shell already provides significant value really to market participants.
Yeah. And then probably rounding up that question, I mean, those are very specific, very tailor-made structures with temperature strikes and, you know, the right gas strikes and so, and sometimes even it can be a sigmoid function underneath and then having the corresponding gas strikes. So it's very tailor-made, most of the quantities are actually trading. So there, again, the challenge is how you want to standardize it. I guess there are ways, but, you know, in general, quantos take one of the most time actually to negotiate them and really properly work on them. That's at least our side. I don't know, Akin, what you see on, you know, on your side more, but giving a risk taker perspective, quantos are a little bit more the challenging side for us, right?
Mm-hmm. All right, we already at the end. The hour is over. It was a quick one. Thank you very much. I think we at least touched the surface of this kind of super exciting topic, and hope we got across what we plan here and what we envision jointly for this market to develop. Really thanking very much my guests here today, Ronnie, Akin, for contributing amazingly to this conversation, and thank you to all the market participants. If you customer participants, if you want to learn more, just reach out via LinkedIn or our website. We can provide you with detailed information on the products and how to use them. The team is here and ready to take your further questions and help you get going in weather trading. Wonderful. Thanks a lot. Hope to see you all soon again, and have a good day. Bye.
Thank you. Bye.
Bye.